Anka, great to be with you all. It's always a pleasure to be on these super events. You've got a great crowd and great topics today, and we're going to talk today about my favorite indicators that allow me to target gains of up to 300% using cheap options, $1 options. They're priced at $1 or less a contract. That means one contract would cost you $100 or less to control $100, 100 shares of stock. So we're going to get into that today. Just a reminder, I'm going to show you a ton of examples, but just a reminder that everything I'm sharing with you today is for your information and education only. Nothing that I talk about here should be considered a specific recommendation to buy or sell any particular investment. Of course, you know that you are solely responsible for your own investment decisions. Big Trends and staff are not responsible for any trades you choose to make. And this is a high risk strategy I'm talking about today. So it's high risk, high reward. So it's typical that, the more reward you seek, the more risk you're going to take. We're still going to talk about how we manage that risk with options and using my favorite indicators. But bottom line is that you need to definitely keep in mind to trade only with risk capital. And we don't provide any personalized financial, tax, or legal advice at Big Trends. We call out real-time trade alerts to our Grand Slam option subscribers with the strategy I'm going to teach you today in real-time email and real-time text to your smartphone. So more on that later. So what are we going to talk about? In the baseball analogy, obviously it's been a very unusual year in so many ways. Obviously the baseball season has been shortened and condensed dramatically. But, the idea is in baseball, that you're trying to score runs. Same thing in your portfolio. You're trying to score winning trades that will boost your portfolio to get you ahead of the game, ahead of the markets over time. And what we're not interested in this strategy is small gains, first base on the first of the four bases here. We're interested in at least getting a double, which of course in investment terms, this would be second base in baseball terms, but double, as you know, in options trade, 100%. You think, well, that doesn't sound very easy to do in today's markets. Actually, it's very manageable to do. Obviously, any trade involves risk. You can lose what you put into it when you're buying an option. But the goal is you want to make multiples of that. So you want to get, if we can get a double, we want to sell half of our position at 100% gain. What does that do? It creates what we call a free trade, which means that now you've gotten your risk capital back in your pocket. If you put $1,000 into a trade, now you're up to $2,000. You take that original $1,000 of risk capital, put it in your pocket, and now you've got $1,000 left. Some people call it the market's money. I say, no, it's still your money, but the goal is manage it well. What we try to do from there is go for a triple, which would be a 200% gain on your initial investment. So if you bought an option for $100, so you got 10 contracts, you sold half of those contracts at $2, you sell another half of your position, or say 2 of your remaining 5 in this case, or 3 of your remaining 5, your choice, but basically about half your position at a triple, and now you're shooting for the final piece, which is plus 300%. Well, that's not going to happen all the time. There are times where it can happen in big batches, like what we saw in January when the market was really surging. We were able to cash out a lot of stuff and dramatically, basically make what would be the equivalent of several years worth of performance in 1 month. I don't promise that every month, but the idea being that, it's about how do you get those kind of big gains. And this is for the aggressive growth part of your portfolio when you're looking to get that growth kicker. Now, we're talking about favorite indicators today, and the big 3 that I'm going to focus you on today, and then I use it to leverage it with these cheaper options, is 1, the CCI, that's the Commodity Channel Index. 2 is the Big Trends band, which is a focus based off of Larry Williams' percent range or percent R indicator. And 3 is the ADX, the average directional movement, developed by Wells Wilder. Now notice, technically I didn't create any of these indicators initially. Obviously I've modified Larry Williams' percent R to make the Big Trends bands. But what I notice is I call it standing on the shoulders of giants. I want to borrow from what's worked for really good traders and innovators out there. And so that's what I'm going to share with you today, and how then I take these ideas out of individual stocks, move them over into aggressive options. So how would you have done if you followed this Grand Slam option system from the start of our model portfolio, the beginning of 2017 to present? Here we are, about 3.5 years, almost 3 3/4 years later, at the end of August here. And if you put in $1,000 a trade, again, there's no guarantee about future performance from past results. But the bottom line is that you put in $1,000 or less into a trade, never more than $1,000 into a trade on a model $10,000 portfolio, it'd be up to like $40,794. So the profit would be actually a 4-bagger as well. You'd be up $30,794 in profits, $40,794 total from initial 10,000 starting point, some 3 years and 8 months later. Now, the goal of this is to say, okay, obviously we've got to learn how to manage risk, get the gains, but also limit our losses along the way. There's going to be risks, there's going to be losses. We're just going to have to remind you ways that we manage that. So let's start talking about the indicators, the pieces of the puzzle that make up my indicator set for Grand Slam. We'll talk about some of the recent gainers like AMD, Advanced Micro Devices, big news. It passed Intel basically in stock price and essentially in leadership in the chip space. Of course, NVIDIA is another big one that's out there in the chip space, but AMD has been one of the best winners over the last several years on the upside in the tech space. And the idea here is that, okay, when we get a signal, let's talk about what a signal would look like. Okay, so what we have on here is our big trends bands, or the upper blue line here is let's call it we'll call it the bands here. We'll call it the upper band. We'll call it UB, upper band. Okay, the lower band, it would be this black line down here. We're not going to mess with that band here because that's just telling you when you're in a range here, which this stock was in a range for, you can see a lot of July until the latter part of July. It was really stuck in the mud. In fact, you get a question mark where it looks like you're kind of getting a breakout possibly setting up here on July 9th. And this is where a lot of people make a mistake, not just in trading stocks, but especially in trading options. They get too excitable and say, oh man, look at that great surge that it just had. Well, notice it's just kind of trying to get through that upper band here. We're just starting to get, this is the percent R. We'll mark this middle panel here. It's a percent range. Larry Williams developed this, and we'll talk more about each of these a bunch here. But there's a few other pieces on this puzzle. This one here is the CCI. And notice these are looking like they're trying to break out in that bar here. But the question is what happens after that point here? There is no follow through. I call this confirmation here. If you don't get confirmation in your trades, folks, you are totally jumping the gun and setting yourself up for buying fake outs, not true breakouts. So what I do is I say, okay, then, and ADX, by the way, is down here in this green line here. Let's put an A by it for ADX. That's not even quite turned in the right structure just yet. So let's look at that. I avoid that fake out. And this is just as important as breakouts. It's saying, okay, the next one that's happening, you see is happening right in here on this close. So we're closing above that CCI blue line there. That's the commodity channel index. I use it for a lot of stocks. Doing the same thing as percent R. And the ADX is getting close to going, but it's still not quite where I want it to be. So it's not yet where I need it. Now notice though, what I'm looking for here is it's got to close above that high. And notice the next bar, it tries, fails. So if it fails in the next bar, should you give up on the signal? No. If we're still in that overbought zone, this is a big thing for me, is that the word overbought is so misused and so misunderstood by most traders that it's costing you a lot of money and a lot of opportunity if you don't trade this the right way, which is that overbought going more of a bot can be very good, very bullish, believe it or not, when you see this kind of a pattern happening here. So what we're looking at here is that you see this, this move happening when we're getting into this breakout. And here's the confirmation happening now. We're getting the big surge through that resistance right here into the close on AMD, and the stock's trading here about 62 bucks. Now, you see, I'm buying the next morning when it actually opens down or actually opens flat and actually goes against me. This first day, I'm actually down on this trade. Guess what? That happens. Everybody who shows you that they're always right, I would not walk. I would run away from that. There are going to be times where we're wrong. But what we're doing is we're following these patterns, which says that the ADX has now crossed above a low level and says that we're in a trending market to the upside because the positive movement's above the negative movement. Now, I know I'm throwing a lot at you on one slide. We're going to keep reinforcing it over the course of this almost hour together. So bottom line is, okay, I'm buying there. Now, that first day, if you put a stop in and just say, okay, I'm going to stop it out if it's down 20, 25, even 30%, you're going to whipsaw yourself out of a lot of trades. This trade was down, I want to say, like in the neighborhood of about a third by that day's close, because I'm buying a pretty aggressive option. I'm buying an August 75 call. And what I always tell people is if this whole thing seems too volatile for you, you don't have to trade the minimum number of contracts I recommend on 4 contracts. You could just trade. You could trade smaller if you want, but I always encourage people to just kind of check it out, see for themselves that there are enough gains that more than offset the losses that are going to happen. This is taking advantage of the leverage of options here. So bottom line here is that you can only lose what you put into a trade. You can make multiples of it with this strategy. So the next day, this is where I'm getting my double and and you can see my double, my triple are both achieved on the second day. So I've gone from down 33% in the option to up 100 and then 200% in 2 trading days. How is that possible? Because think about it. You're buying when the stock was at 62 bucks, you bought a 75 strike call. You go, this thing's got to move really fast to get to where it needs to go. This was about a week before AMD reported earnings in late July, and then boom, the stock's gone from 62, closed at 60, and the next day it's at 70 bucks almost. So once it's 70 bucks, we're saying, okay, now all of a sudden that 75 call is in striking distance. You're only 5 points away rather than 15 points away. This is also called the gamma effect of buying out of the money options that go closer to the money and then in the money. It's where you get really dramatic leverage as the options go from out of the money to at the money and then in the money. And I'll try to pick up chat questions along the way. Thanks, Jennifer. Grand Slam is the name of the service, Grand Slam Options. Nishant, does ADX work on monthly charts? It works on all time frames. It's just that obviously you want to kind of tie it to the type of option, the type of underlying that you want to trade and invest in. And the ADX you're going to find when you plug this in is really powerful. I can't give away all the settings of all the indicators here, but when you sign up for this awesome 1 month try it out for very cheap, you'll be able to get access to all that stuff just to get you started, and then you can track it on any time frame. I'm using daily charts here, by the way. I've used this on 30-minute charts, hourly charts, daily charts, and even weekly and monthly. So it works well in a lot of time frames. Okay, so bottom line is now we're cashing out, and we're still waiting for the triple, and then the next morning it pops up a little higher at about 72 bucks, and it hits our quadruple, I should say, up 300%. That's a 4-bagger. You've hit the home run, the grand slam, as we call it, when you load the bases, hit a home run, you score 4 runs real quick. So the bottom line of this is that we're in this trade for a matter of just a few trading days, and you're not having to worry about what happens with earnings. And another service, we bought it in front of earnings and made some more money on it. But that's this service I really wanted to say, look, we've already gotten all of our targets. Let's take the money and run. So when I think of home runs and think of the baseball analogy, obviously I think of the ultimate home run leader, Hank Aaron. But back in the day when they were using a lot less technology, you had Babe Ruth as truly the personification of the home run hitter. 714 career home runs for the Sultan of SWAT, as he was called. But interestingly enough, he had 1,330 strikeouts too, almost twice as many strikeouts as home runs. I don't want to do that, obviously, when I trade options. But I think that the powerful thing about this quote here is that he says, don't let fear of striking out get in your way. I talk to so many traders. I coach a lot of traders that basically have let fear get in their way. I call it scar tissue. A lot of traders, because of the mistakes they made trading when they didn't know what they were doing, you thought you could do it yourself, thought you could read a few websites for free, take in some free information and figure, okay, now I can start investing real money and I'll be ready to be the next Bill Gates or Warren Buffett in no time. And then you blast yourself with some bad trades, and then you're like, I'll never trade that again. So a lot of people have sworn off buying options because they don't know how to do it correctly. So I'm regularly reminding people that, look, options, you can make money buying them, you can lose money buying them, you can make money selling them, you can lose money selling them. It's just about having the knowledge to know when the conditions are right for one strategy versus another. But we definitely want to minimize the risk. Even with those strikeouts, he was a 6-time champion on the teams that he actually played on. So it can lead you to a really great result in your portfolio if you know how to use these correctly. But this is definitely just for that aggressive kicker. I'm not saying to put all of your cash into just one strategy. I like to stay diversified on a lot of different techniques. So this is my biggest growth piece of my own options trading portfolio. So AstraZeneca, all the talk of COVID vaccines and things that are working. As you know, AstraZeneca, AZN as a symbol, is partnered with the University of Oxford to, have one of the leading candidates for treatment. And so basically we were seeing AstraZeneca just starting to break out. Been watching it for a while. Look at how it hugs that upper resistance line on the big trends bands. Look at how we don't confirm at first. You see this a lot. A lot of first breakout attempts are failed. So if you're ever getting too antsy to buy that first breakout, I always remind people to be patient, to try to, wait until you see, like, we're just starting to see everything crossing out above here right as it breaks out right in here. And I was seeing enough intraday confirmation. I said, you know what? I want to be a part of this because these options are actually quite cheap for how fast that this stock can move if we get any kind of good COVID news. That next weekend, they were going to announce the results of their COVID trials. Guess what? Odds were pretty good that they were going to have some good news to report, at least initially. Again, you've heard the old trading phrase, buy the rumor, sell the news. The rumor is it's just breaking out in the days in front of us, and we're getting all of these indicators syncing up confirmed. And in fact, we're cashing out of the first piece here at 100% into the weekend, and then we're taking out as the stock popped up like 4 points that next Monday morning. We're taking out ultimately a 357% gain on the third trading day in the trade, not counting the weekends. Obviously, we just count the trading days. So you can just see it's all about catching this little sweet spot here where things are breaking outside of these bands. Even this little bar right here, we were below the big trends band. We closed back above it at the end of the day. So think of those big trends bands as like a trading range in between them. I don't want to trade. I don't want to buy options in between those bands. I want to buy options outside of those bands. But I want to sell that news. Once that good news hits, I cashed it out that morning, and then you see it flipped all the way back down towards the lower band. I was not a part of that. I was done with the trade and moving on. So it's about catching the sweet spot. So let's talk about the commodity channel index. The name's kind of a misnomer for the way I use it. It's a stock channel index, the way I use it. But Donald Lambert developed this at the start of the 80s to work on commodities. But it's been shown, especially by our testing, to work on a lot of big name growth stocks. You know where the action is these days. It's tech, it's biotech and vaccine names, drug stocks. It's, there's definitely some other pockets, but from the stay-at-home portfolio names have been where most of the action is, and they've been the strongest on the CCI. So the idea of CCI is different than a lot of other indicators because it's not just keying on the close. Lambert said, let's take the high plus the low plus the close, divide it by 3, and get what he called a typical price, which all that means essentially to me is that, you know what, if something's closing at the highs, you're going to have a big pull on this to the upside. If it's closing at the lows a bunch, you're going to have this thing showing you a downtrend that this is a very weak stock closing at the lows too many times. If it's closing in the middle of its range too much of the time, you're going to have a choppy directionless kind of a CCI, and that's not something we want to trade. We're looking for momentum here. This is like a kind of a power thrust that confirms this unusual definition I have, which is that overbought can be really, really good. I know that just throws so many traders off when I say that, but a big part of what I've learned in my 30 years of trading stocks and options is that the most unconventional things that I've found that tested that work that you would not expect to work are actually the most profitable systems that I use because nobody expects this, and therefore you can get a big edge on the crowd. Even in the pandemic in March, our Grand Slam portfolio was up, mainly thanks to one name, Kroger. You would think, well, you must have made a bunch of money on puts in March when the market was plunging. The problem I had with a lot of the put trades in March is that the volatilities were so high that you had to pay a fortune and you had to be right about things literally going to next to nothing, it seemed like, to really make money on puts. It turned out you could have still made some decent money on puts, but the risk was definitely elevated. And when that market flipped off the March 23rd bottom, you had big problems if you were in any kind of bearish bets because it was a double whammy of price action moving back up, but also volatilities collapsing. Okay, so this is that other thing that makes option trading so hard for a lot of traders compared to stock trading. A lot of people jump from stocks to options, think that should be easy. Well, guess what? It's not just about getting the underlying right. It's about making sure you don't overpay for something and making sure that you get a fair price for it, and also that your timing is good, that you're proactive enough to say, okay, we're going to take some money off the table and then see what happens. So our goal is to take that double in the first half. Now, sometimes you see this first trade here on Kroger, March 5th. I never would have thought that I would day trade Kroger for about a double, but that first day we got in, the stock ran dramatically from the low, about 31 area, up to almost 34, about a 10% move in Kroger in a day. Our system was picking it up and saying, this is a big time breakout. And instead of waiting for the close, we actually got in there intraday. And actually, one of our auto trading brokers told us we got a little bit higher price on entry than what we were initially told. We thought we were working with a 91-cent average entry. They came back later and said they got in closer to 99 cents. So we had to use a little higher average entry, which is why our double target looks a little bit off here. But you know what? I'll take 91% in a day. In a few hours, really. And then we said, okay, then it rolled over on us this time and came back near break even. We took the second half out at 10%. See, if that happens, a lot of times if you've been in a double in an option trade and now you're back near break even, you're going, Oh, well, I'll wait for it to go back up to a double and then I'll get out. Well, you see, a lot of times the market does not give you that opportunity. So we take that trailing stop, as it's called, and say, okay, take the small profit on the second half. And we averaged in this trade, as you can see, about a 45, 46% gain on that trade for a day and a half's work. Not bad, but we did better the next time. The next time we see the same thing happening on the intraday chart. Look at this. We're seeing the first time the ADX is just turning up. Look, the ADX is just turning up again here off this surge on the 16th. And we're saying, okay, look, we're getting the CCI is coming right off of a nice what we call a retracement retest under its key threshold and starting to turn back up. Only percent R was a little bit spotty because of this intraday sort of a tail that this high bar left made that percent R not look quite as good as it probably normally should. But bottom line is that the intraday charts were all firing. We're saying we see another opportunity in Kroger. Remember, this is when people were worried about, is there going to be toilet paper on the shelves? There wasn't during that first wave of the pandemic buying, right? So Kroger, Target, Walmart, they were all benefiting from this just flocking and clearing out of the stores. But the point is, we saw this happen again where it had that first big surge. We got that double that next morning as it's taking off. But you know what? I wasn't going to get caught waiting on this. I had to adapt my method a little bit because I said, you know what? I gave back some profit that first time here. Didn't want to do that again here. So up into here, we said, let's just take the second half out at near a double. I don't like that it's stalling intraday. We'll take the 92% gain that second day in the trade. And we were glad we did because you see what happened. It gave up that and then it just shot on back down towards the lower band here. So this was a little trickier environment to trade in March, I got to say. But I'd say based on, my 30 years of experience, I said, you know what, sometimes you learn that a bird in the hand is worth two in the bush or three in the bush as our targets go here. We adapted to the environment and said, look, we're going to go ahead and take that off the table, take it down. And like I said, those two Kroger gains made for a profitable month of March, even when everybody else was getting crushed on the downside in the pandemic wave down. Now, the third leg of the stool, we talked about at least CCI. We'll talk about ADX here. One of the other legs of the stool. This is the average directional movement index. This is all about trends, folks. I don't trade the ranges. I'm not interested in that kind of small gain seeking, scalping. I'm looking for the bigger move, the faster move, and the more dramatic move, preferably in as short a time as possible. When I launched BigTrends.com in 1999, and David actually worked for me for several of those years. We've stayed in great touch since he was definitely one of our early contributors to helping get Big Trends going. Bottom line is that, the idea here is that, it was about finding big trends on any time frame, even an intraday short-term move here. So the idea here is that we're looking for a very unique pattern here, which is that we want to see a lot of positive directional movement. If you're looking at an uptrend channel, the positive directional movement should be going up. And if you look at the negative directional movement, it should be going down. So we got less and less new lows. We've got more and more new highs. So that's going to make the ADX go up because you're going to see those directional movement lines converging or diverging away from each other and pulling that ADX higher. Here's another one that actually we got on back earlier in the year. Turns out Mr. Buffett, just turning 90, happy birthday, Warren, just bought a big position in Barrick Gold here recently. And we've been talking about gold for a number of years as a great way to play that inflation was greater than what's expected. Now the Fed is telling us that they actually want more inflation than what they had previously targeted. So surprise, surprise, guess what? Gold's a big beneficiary on that. Well, GOLD, Barrick Gold, now the symbol is GOLD. They actually took over Rand Gold, which was a stock I'd liked since back in 07, 08. But bottom line is that they got a great symbol there. GOLD, this was probably one of the cheapest options I had seen for something that I knew could move a lot more than what the options market was pricing for. This is a great example where, look, you're getting all these setup points here. Notice the prior setup points here for percent R here and for CCI right here. Neither one of them got through those highs. Shooting back down here, that's a failure. That's a fake out, not a breakout. Okay, so when we're setting up here, now the ADX is setting up on the same bar. This is happening there mid-February, right around Valentine's Day. See what's happening. There's my setup right there. It's at like 19 and a quarter, and my close the next day about 19 and 3/4. So we're saying that's a bullish confirmation. We're buying right off of this open here, just under $20 right here. Okay, what are we buying? We're buying a March 20 call. And this gets to the type of option I like to buy, a March monthly option It's the third Friday in March is the expiration. We're paying $59 a contract. 59 cents is how it's quoted, but now that's times 100 shares for one contract means it costs you $59 to control this option through the third Friday in March. We're not even to the third Friday in February yet. We got about 5 weeks to go till the expiration. You're saying, okay, look, it doubles the next day. So when it goes from 20 to 21, about a 5% move in the stock, we make 100%. It's about a 20 to 1 leverage. And then it keeps on trending up. Look, it's staying outside of these big trends bands here, right? That rectangle, while percent R stays essentially flat because it can't go above the 100 percentile mark here, the channel is definitely directionally biased to the upside. The CCI, of course, is confirmed. We've got it color-coded in yellow to say it's where it's actually staying, in this case, above that plus 100 level. But, bottom line is that it's just a beautiful uptrend. When it gaps up, look, from a prior day to the next day, it gaps up here to 22.5. The stock is up. You can see about maybe 12% from where we got in. We're making on that second half of our position because it actually hit through our 200% target into our 300% area. So let's just take the whole second half out plus 289 and change. That we're saying, okay, look at the leverage on that. You took a 12% move in the stock up to 289%, and you're talking about nearly 15 to 1, 14 to 1 leverage on the, 24 to 1 leverage on the underlying. So 24, 25 times your money on that kind of a 1 week move is really tremendous. And you see, you're not putting your capital out there for a long time. The third leg of the stool, I said, big trends bands is my modification to help visualize what Larry Williams developed. He's a true innovator as well in the trading game. Percent R, percent range is saying it should tell you in the last, whatever look back period you have. If you're looking at the last month's worth of action, you'd look at the high and low for the last month. That would be your range. And then you'd say, okay, where's the stock trading within that range to give you a percent R reading, which I use a positive scale from 0 to 100%. If it's at the highs of that range, it's at 100%. You'd think that sounds like it's overbought, right? But what happens when something comes out of this range? You see that we move through this resistance line here of the big trends bands, and we keep going up. That's that confirmation that says something's happening there. The institutions are not selling this top of this range. They're saying, I want more of Baidu. I'll have more, please every day, more, right? So the idea being that, you know what, if we're buying this out of the money call on Baidu, it's getting closer and closer to the money and eventually going in the money, 100, 200, 300% in 4 trading days. You say, well, in this one, we got out too early. And I say, yes, if that's going to be my fault, that I sometimes sell too early at plus 300%, I will take that as a fault and say sometimes that last piece could go even more. Sometimes it could shoot back against you. So the idea for me is to take profits gradually as the market makes money available to me. I love how Larry talked about the 80 and 20% levels because it reminds me of Pareto's principle, the 80-20 rule. You've heard of it. It means that 20% of your actions or 20% of what you do is going to drive 80% of your results. In trading, in theory, 20% of your trades drives 80% of your profits. In options buying, it's actually even more dramatic. Sometimes less than 20% drives 100% or more of your profit. But the idea here is that you're looking for these outliers, as Malcolm Gladwell's book called it, where something stays overbought and it stays overbought longer than anybody would expect. That red line, I leave it color-coded red. It's supposed to be a warning sign when it's overbought, but is that a warning time for Baidu? No, it's a big-time opportunity to the upside. So now when you layer all these, that same chart, layer all together, percent R is confirming right after that, breakout, CCI comes in the day after that, and then the ADX is already confirmed from back before. It's like layers. It's like, how many indicators do you want to use to get confident about your trade? You don't want to use too many. Some would say 3 is too much. I think it's like legs of a stool, 2's wobbly, 3 is solid. A lot of people are trying to balance on one leg of a stool or saying, I only trade price action. And I say to those people, you probably need a neck brace for all the whiplash you're going to incur if you just trade price action. I would rather say, show me the sweet spot where this thing's really steadily trending outside this band. And I just want to get a piece of that move. I don't even need to get that whole move. And I'm very happy with 100, 200, 300% gains in a short time period. This is another Baidu trade that it was a little different one because it actually gapped up on earnings. And when it gapped up on earnings, it kind of didn't follow through at first, but it went through what I call a wedge. You've heard of wedges in trading. It was just coming out of that trading wedge where things are really compressing. Some call that a squeeze. There's a lot of different things you can call it, but the bottom line is that as it's coming out of that wedge pattern here, I'm saying this thing's ready to go the upside, folks. It had a nice consolidation after earnings. The ADX is trending up here. Percent R's overbought and staying overbought. We're breaking through that resistance, and CCI is coming on board as well, and boom, we catch it for that quick little pop. And this is a great example to say, okay, look, this one took 6 trading days instead of 4, right? 100, 200, and 300 on the 6th day. Now, on the 7th day, the stock rested, okay? And you're saying, I'm glad I got out. And then the 8th day, so there's 7, you're thinking, I'm smart for getting out. The 8th day, you're going, oh, I'm such a dummy for having sold it. Now it's even higher. Do you ever play that game with yourself? I do it. I try not to. But now I do it a lot less because the indicators tell me when the odds are in my favor and when it's not in my favor. You see the 9th day, you're kind of losing momentum. And the 10th day, if you're still holding on, the 11th day, oh my goodness, you're just absolutely in despair for not having booked your profits earlier, right? So the idea is that, and Jack asked, how can we get the percent R indicator? What markets does it work on? It's available on most platforms. It's usually just Williams percent R. Some places have it as percent range or percent sign R. The Big Trends Bands version of it is something off of my toolkit, but you can get percent R and at least visualize that overbought, staying overbought for a long time there. That's what we're after. So yeah, so we're and the CCI Mark asked about, that's commodity channel index. That's on most platforms as well. My settings are a little different, so you want to take advantage of the 1 month kind of a low dollar trial that you'll see it from me at the end to really get all the specific settings. And I just ask you use it for your own benefit. Don't share it on the web. That'd be a violation of our terms of service. Okay, just it's about taking advantage of things that I've tested at work over many years. Okay, now Greeks. When you think options, most people think about probably Theta as the first options Greek they think of because they're going, oh, time decay. Hate it. Don't like to buy options because the time's eroding. It's like a melting ice cube. It is. That's definitely something you have to be careful about. Vega is really more of a factor if you're doing earnings trades. You got to worry about Vega and volatility changes. I don't really worry about that here because I'm not trying to trade right in front of earnings. In fact, the only time I'll trade in front of earnings is if I get a free trade before the earnings report, which I'll show you an example of that later. This is what I focused on when I launched Big Trends in 99. Mid to late 90s, I made my money by buying a lot of in-the-money options on the tech names, the Microsofts, the AOLs, the Dells, the CMGIs, the GoToNets. I remember a lot of them finally because they really helped me found my company. I had a nice cushion to basically when I launched Big Trends in late 99, I was like, okay, we had a bear market coming. I knew it. I told Barron's in September 2000, watch out below. We had a 2-year bear market from that point, and told them again in early 2002 after 9/11 bounce that we were not done. We were going to go lower. So that helped put us on the map. To call out bear moves, not just bull moves. But the thing that I didn't know much about at the time that I now know a lot more about is gamma. And that's how fast you can pick up delta. That's like a second derivative. I'm not going to get into the math of it here, but the idea is that you actually pick up the deltas fastest when something goes from out of the money to in the money. Out of the money, at the money, in the money. That's where you make your best money buying options because they have the higher gamma. So here's an interesting example of Morgan Stanley, MS. This is not your typical momentum name you would think of, right? And this is one where I was wrong initially, okay? This is why my stop rule is different than what you're probably used to. It's not a price stop, it's a time stop at first. Here's my setup point. And you see on the circle, at that close, I'm saying, okay, you know what? We're getting our confirmation here that we need to be a part of this. So I'm in there buying there the next morning's open, actually. I'm buying right there. And you say, that was a terrible move because it dropped and went down for the next 2 bars, 1 and 2. I'm losing money that first and second day, okay? But my rule is wait for at least the 5th day and get the 5 days behind you. And if the stock is against you by the 5th day, then you got to get out at that day's close or a future day that it's against you. Notice we're right back right where we got in. So you say, okay, look, we're right back where we got in. It's crunch time. 6th day, we're up. 7th day in the morning, it gaps up. We're saying thank you very much at $51. And in this case, I bought the 49 calls when the stock was about 46 bucks. I bought the 49 calls, paid 95 bucks a contract, quoted as 95 cents, 95 bucks a contract. So if you bought 4 contracts, it cost you like 380 bucks. Commissions are now next to nothing. Just maybe a few bucks in commissions on each side for a 4 lot. It probably costs you like what is that, like $2.60 at a lot of brokers now. Unbelievable how cheap commissions are now for options trading, next to nothing. 247%, 224%, the final trailing stop 146%. That combined to average 220% on the whole trade in 7 trading days. The time stop saved me. If I got out here 2 days down, or even the first day down, I'd be down 50, even 66%. I think I'm down about 65% on the second day. You say, how can you have the guts to hang in down 65%? Because I'm not trading too much of my capital on any one trade. If you buy out of the money options, you have to live with the fact that once in a while those things are going to get crushed, or even might even wipe out against you. And you say, how can you accept that? Because this is something that's it's not for the faint of heart, but it's the dramatic leverage to the upside. If I stopped it out down 60% and then it turns around and goes up 220, that's a 280 percentage point swing that I've left on the table. I know you've all experienced it, where you stop something out and it goes on without you, and there's nothing that feels quite worse than trading than being right and actually losing money. And that's why I say give it a chance. And then the question is, okay, what's the right sweet spot on time to work with? The right sweet spot for me is typically 30 days to about 40 days out before expiration, about 4 to 6 weeks before the expiration. Because if I give it a 5-day time window here, somewhere like 40 days, say down to 35 days, I'm going to lose a little bit of decay, maybe a hair more from 35 days down to 30 days. What I don't want to do is take the last 2 weeks before the option's life and try to trade that at all. Do not trade 2 weeks before expiration or less with this strategy using a daily chart. It's too risky. There's things I do use with weekly options, but that's basically something that's even more turbocharged. And basically, I'm trying to find a sweet spot for the average subscriber that can stick it out and not have to overreact too much intraday. So the idea here is this is like day-to-day updates and monitoring this and saying, okay, after 5 days, if we're wrong, we get out. If we hold on, whether it's a win, lose, or draw, and we're 2 weeks from expiration, we get out here no matter what. You have to exit at the 14th day before expiration because it's too much decay to overcome. But that's not that much decay to overcome. And this little tiny sliver here for 5 days here, you say, why not trade 120 days out and just have this tiny sliver of time lost for a whole 30-day hold? Because you will have to pay so much time premium for those, your leverage gets crushed and you basically lose the opportunity that I'm showing you to capture these quick swings. What about a name like Zoom Video? This is actually what I call a retest trade. The yellow line here is a CCI. It's got a retest happening when it comes underneath that level. That happened right off of this low right here. This low, it then came back down and tested right off of my big trends bands, right off of the CCI retest, right around 115 bucks. I said, you know what? It's crunch time for Zoom. It's either going to flip back up. It had some bad news about some privacy issues. Some competitors were trashing it and saying, Microsoft saying, okay, they're not allowing their employees to use Zoom. Surprise, because they have a different product, Teams, that they're trying to get people to use, right? Of course, they're not going to let them use it. But you know what? As you know, it's become, as we're using Zoom here today, it's become a Zoom-based world in the pandemic. Well, we bought the 200 strike calls when the stock was at 115. That sounds absurd, out of the money, right? We paid $1. I said, I even had a subscriber say, you know, this bad news, there's no way you can expect that trade to pay off. And I said, give it the 5 days. Okay. 1, 2, 3, 4, 5 days. Guess what? On the 5th day, we cashed out at 100 and 200% on our first 2 targets. Now, notice where we are. This is a little different trade because we're back at the big trends band now acting as resistance from coming from underneath. It was definitely a little bit of a different trade, but I said the risk reward of that trade was so good that it was worth taking a shot. And then the next day, as it started to roll over intraday, it came back down to 117%. I said, let's get rid of it after the 7th day. Again, this is one of those that for a few days we felt pretty smart. Then it runs up, then it flattens out. With all the time decay in Zoom options, you got to really be hitting it fast and hard. Okay, Zoom's up 10% after market right now, says Steven. Yeah, I mean, it's a really phenomenal story, but it's all about, again, I'm not recommending it here. I'm saying let's just make sure we get it in that sweet spot where the risk reward makes sense. So we've got a lot of tech names in our portfolio. You've seen a lot of them already here. Mr. Softy, I'm going to get to in a minute. NVIDIA, you know, it's been a monster. As you know, Tesla, just with the split, Apple is on our list, even though we do trade the FANG names as well in its separate service. Bottom line is that there's a lot of names that you wouldn't think of, like Visa and MasterCard are solid, but do you think they're spectacular? Well, they can be. The casinos haven't been spectacular, but they can be. And we look to trade them both ways too if we get an opportunity here. So there's a lot of different options that we can trade. I'm going to move through a couple of these because I've got only so much time here today. Move through these quickly, but the idea of an option chart is something that nobody else in the options space hardly talks about. And I'm saying, you know what? An option chart is so different from a stock chart because, as you know, an option is a time-limited asset. The decay curve I showed you is important. If you buy Apple stock, it should outlast you and me on our lifetimes here on this earth. If you buy Apple calls with a month to go, you've got 30 days for something to happen or less. So basically you've got to make it happen. Volatility, obviously a big factor as well. So we've got to manage this decay and let that chart really work for us. Now, I mentioned an earnings trade example. The only time I would trade and hold into earnings if I'd already taken my double on half my position. Here's an example of Microsoft. Well, quite a ways back actually, but you can see here 80 calls, got a double on this. We bought them for 55 cents, 55 bucks a contract as we're getting the breakout. You see the breakout was happening on percent R, and then the ADX and CCI on the same bar, but then the ADX came in a little bit later right here. And so we're saying, okay, now everything's confirmed. So we want to buy on this morning, and then it pops up to a double after about 6 trading days. And then look at what happens. Right before the earnings, it flatlines for 4 days. It's right into the big trends band support. It's staying overbought on CCI. Look at the ADX. Is it going down? The green line's still going up. It's still trending to the upside. So we said at 79 bucks heading into earnings, we're going to hold these 80 calls. Seems risky, right? But then it gapped up $84.30. We sold them for, as our option chart shows, for 756% gain. Here's the option chart. Interestingly enough, the option chart was actually showing the breakout and the confirmation about a week before the earnings. So you can see, look at your ADX on the option trending up. Look at how your CCI is going into overbought territory. Overbought's good, remember. Here's our retest on the percent R at about $1 on the option. It tests underneath there intraday, holds that buck level at the close, still holding above $1. Opens the next morning on the earnings gap up at $4.71. 55 cents to 471 is 756% gain. That's atypical. It's not what we expect, but every once in a while you can hit one of those home runs with that free trade concept with an earnings gap. So we keep expanding our tailor-made list of these stocks. There's now up over 50 of these key stocks that we follow. They're mainly your growth leaders in the market, but they can be good downtrend plays too. So you've got to stay flexible when we get into another downtrend, which will happen. But right now, we've been mostly on the bullish side. Obviously, it's been where most of the action is. But these outliers is essentially what we're taking advantage of. Using the gamma boosting strategy to say you've got to be ready to take advantage of these cheap options, and you can do so on the downside. I mentioned that. Here's a couple of downside examples. BABA, 140 strike put. When the stock's trading, you see breaking down below the lower band, that black band here, you can see is already broken. So we're getting in there. The very next day it gaps down, we make 100% the next day after we enter. Now, I didn't like what I was seeing as it was starting to reverse back the other direction the second day in the trade, and said, look, we're up to about 150% that next morning, but then it was back to 69% and said, okay, get rid of it. It's not falling through to the downside. Let's move on out. Even though all the indicators look like they were a very cautious light to the downside, we said, you know what, it's too much of a reversal. We can't afford to see that much give back in a position. Here's a bearish one with GM off the pandemic first bounce on GM. I said, you know what, when General Motors is not focusing on making cars, they're focused on making ventilators. I was like, good for them and good for trying to be creative, but it tells you how bad the auto business is for them if that's the case. And that said, that, to me, this is a bear retest scenario here. We're right back into what we call a CCI retest zone, and everything's telling us that the resistance should hold here. You see, for a couple of days, it just flattens out. You had to buy, when the stock's about 22 bucks, you had to buy an 18 put to pay $1 for it. I'm saying we know we've got to get a move quickly on this. As it came back down into my lower big trends band here and it didn't show a lot of follow through intraday, I said, let's take the 50% gain in 5 trading days and move on. Glad we did, because of course the market bottom pulled all that stuff back up. So when you think about what are the elements that it takes to be successful, and I'll answer a question here from Mark. He says, are the equities mentioned under $1 contract? It's the options on those stocks, Mark. So basically you're saying, look, if you've got a stock, whether it's trading at $20 or $200, if I see a big trend signal for a grand slam options trade, I want to be able to buy whatever the appropriate out of the money option is, assuming that I think that it's reasonably priced enough. It's all about making sure you're not paying stupid prices for something. At the same time, the market has really clearly rewarded the handful of names unduly. You say extra duly compared to a lot of the other stocks in the S&P. As you know, the top 6 names, the FANG names plus Microsoft, are something like 25% of the entire S&P 500 market capitalization. So when you say, okay, there's opportunity there, yes, there's been opportunity upside, and there will likely at some point be opportunity on the downside. I want to stay flexible to trade them both ways. I know that sounds like heresy to so many of you that have completely bought into the FANG stocks control the universe now, but remember, they're a bigger weighting as the top 5 or 6 names than the top 5 or 6 were in late 99, early 2000. I'm not saying they're there yet as the top, but I'm saying, I'm staying flexible. Let's just put it that way. And I think you should too. So the catalyst has got to be there with these technical patterns lining up. It could be also tied to we had a great earnings report or a terrible earnings report on the downside. So that's important. And then we want to keep this time stop at 5 days. So the time stop is such a different concept for so many people than the price stop. You know what? Sometimes time stop hits, we might be down 50% on a position. That happens. We could be down more, we could be down less. But odds are we're going to be down if the stock's flat or against us. If it's a for us, we let it keep running until it goes to flattening out. Once we get a double, we sell half, 200%, another half of our remaining half, a quarter of our original, and the final quarter at the 300% target if we can get those targets achieved. But this is critical right here. Do not overcommit your capital on any one trade. 5 to 10% of your capital that you allocate to the service going into any new trade, no matter how well you're doing. The greed is something that will get you on any strategy, particularly this one that can make money so quickly when we have a really clean trending environment. We've had some beautiful trend moves in this year when a lot of other people are wringing their hands. And, it's one of those things where obviously I do encourage people with the profits that you can make with this, take some of those profits and give it to those less fortunate. Make sure that you up your giving when a lot of people are cutting back theirs. When you learn this, that's another great reason to say it'll help you be even more giving to those that you know in need or that can use a helping hand. Weekly video training is important. This is not a black box system. As I said, when you sign up, you can actually take advantage of learning the specific parameters and then plugging it in yourself, following it, and learning how to trade it yourself over time with the week by week training modules I give you. So like I said, past performance does not guarantee future results. We all know that. I'm going to show you the order page though with a great special you can take advantage of on the next slide and answer a few more questions here. Say, look, it's all about, and Jennifer, yes, charitable is lovely. It's all about being able to give back. And also that adds to the abundance mentality that's going to just make you that much more motivated in your trading. If you're not already motivated for yourself and your family, knowing that other people can benefit from you doing things the right way, following a system and a method is the key. This is not random, folks. This is not about just saying you woke up on the right side of the bed, you made money, you woke up on the wrong side of the bed, you lost money. Sometimes life and trading can feel that way, can it? But there is order in the markets, and that's what this whole days worth of favorite indicators is about. It's about finding patterns, finding order in the market that can produce a result like taking 10,000 over 40,000 and a 30,000 plus profit. Again, knowing that there's going to be losing trades, you're going to have up months and down months. You're going to have times where, you're like, okay, I need to save some for a rainy day. I'm not going to keep just compounding it. And by the way, this is not compounded. If I compounded it, it would be ridiculous how much. This is saying if we only took $1,000 a trade, even as we grow the portfolio by fourfold, we're still only putting $1,000 a trade in, even though the portfolio is up to 40,000 and change now in the model tracking vehicle here. So we're actually putting in a lot less than even the 5% that I show you when we're putting $1,000 on the grown portfolio. Now, usually you would not be able to get the $47 special that I'm going to give you today, but because David and Anka have been so good to me and appreciate being included in these, and it's always a lot of fun to get people started and have you see the light of something you've been totally missing and in the dark on. For example, the overbought concept, going more overbought. That's where you make the big money in options buying. When overbought stays overbought and keeps going. That's totally contrary to what every other textbook's going to tell you practically. And so the idea here, and thanks for posting that link for me, David, it's actually members.bigtrends.com/slam. I'm going to show you this page here in a second. Usually, like I said, you'd pay 2-year special. Usually it'd be $6,000 on my website. It's $1,500 as a special I just did. for 2 years, or even the 1-year special is a fantastic value, usually $3,000 down to $1,000. Just did that for my Big Trends community. Guess what I'm going to do for you? Something that's going to allow you to get started even better. I'm going to say, you know what? I'm going to take our usual best monthly price of $147. That's our best price. And I'm going to cut it for the first 30 days for you to try this out for $47. No shipping, no taxes, unless you're in the state of Kentucky like David and I are. Bottom line is at $47 to try it out for the next 30 days. That's like $1.50 a day, or less than that, or right at that, actually, $1.55 a day. Bottom line is that for about what these contracts are priced at, right? Bottom line is that that for $47, you're going to be able to expect that you could get in the neighborhood of about 6, 7, 8 trades over the next 30 days. I'm not going to expect that we have to give you a ton of trades to have you be an absolutely thrilled subscriber. Hit the green checkout button. I'm going to expect that, just get one of these, just one of these 100, 200, 300s. If you're putting in if you put in $1,000, I expect you to potentially make, almost triple on that, where you can almost make a couple $1,000 on one of those 100, 200, 300% targets the way I explain it to you. You'd be up very nicely, right? Even if you put in like $400, you could take that to like $1,100. So you're talking about, like, for $47, one of those trades on just 4 contracts, you can't even trade more than $400. $400 could turn in, a really nice, 15 times your money on that $47. Now, after 30 days, it will auto bill every 30 days at $147. That's my best monthly rate. And that's why maybe once you see how well we do for you over the next 30 days, you may want to call us at our 800 Big Trends line and say, hey, saw you on the special favorite indicators event and would like to upgrade. But bottom line is, we got a secure site here through one shopping cart, where basically you put in whatever credit card you want. You say you caught it with me on a webinar. And bottom line is that all you got to do is then review the terms and conditions and then click on the checkbox. The terms are spelled out in full. And we even break out the terms a little more to say this is an automatic renewal program. There are no surprises here. I've told you about this multiple times here. $47 the first month is my way to say save $100 off the usual monthly rate. Just go. It's like obviously a huge savings off of what people are paying for annual and longer subscriptions, to try it out for 30 days. Well, you saw with me, Chris Sarah, a lot of he's my lead consultant, whichever way. Review those terms and then check on that box, hit the green submit order button. You're good to go. If you have problems with it, just call us at our 800 Big Trends line, or email us through clientcare@bigtrends.com. Let me answer a couple of questions, and then I'll hand it back to David in a couple of minutes here. Gabe says, what broker do we recommend for options? That's a good question. You know what? You can actually have this service auto-traded once you become a subscriber. There's a couple of brokers who can help you automatically get into our Grand Slam trades. One of them is the good folks at Thinkorswim, now part of TD Ameritrade. So Thinkorswim, and also Auto Shares. And for more details on auto trading, you really should give us a call first at 800 Big Trends, so you can kind of understand the ins and outs of how that works. But then basically what will happen is you subscribe here, then you contact the broker if you have an account already at one of those, or if you need to get it set up, you can subscribe. Tell us to put this on hold until you get your account set up, and then we'll turn it back on and get your 30 days started as soon as your brokerage account's ready to go. Whatever way you want to go, we try to make it easy and simple for you. I don't want to focus too much on that whole process. You can just call 800 Big Trends if you have questions here. But yeah, so basically, but remember, it's the options on those stocks that is where you create the leverage. So if you're just buying the stocks, and I'm a fan of buying stocks now more than ever, because you know what? Now you can figure out which stocks are in the lead. It used to be that the rising tide was lifting all ships, right? In the passive index investing that everybody was putting their money into, the S&P 500 funds. As you know, this year has exposed that there's totally different trends happening within the S&P 500 now. You got the stay at home, work from home, tech and vaccine stocks and all that kind of benefiting from the push to more digitization. Digitization is the buzzword for 2020, that all the bricks and mortar stuff is vulnerable to not getting customers that can't go to a restaurant, can't go to a place of business, don't want to travel, don't want to stay in a hotel, don't want to go to a particular vacation destination right now because of fears of the pandemic and COVID. And it's just a fact of the way it is for a while. And it may be that while a lot longer than any of us would like it to be. But meanwhile, there's a lot of money to be made on the other names that are benefiting from that digital push. So keep that in mind and say, this is about trading, knowing how to trade flexibly. Um, Jennifer says, my mom let her timeshare lapse. I mean, exactly. I mean, it's one of those environments where you're going, okay, when people are looking at how to save money, if they're not going to use a potential asset like that, then it's really about taking advantage of that. That's why I've been a big fan of actually options over, how to tie up too much capital in the underlying security, because like, hey, why would you buy the house when you can rent it for the time that you want it and then leave it to somebody else? So you get trades, Mark says, at what time? Usually we will send it, it's a good question. Usually we will send the trade sometime about in the first hour of the trading day, so that we can get new signals. We can also get, also, of course, we'll send a reminder. If we've got open positions, we'll say, hey, we're in these positions. Here's what we do: buy, sell, or hold. Here's what we're using for our stop and our target, that kind of a thing. But then new trades will usually come out pretty quickly in the first hour, because we've gotten our signals usually off the prior day's close, and then sometimes we're confirming them with a little bit of the intraday movement in the first bit of the trading day, and then getting in there before 10:30 Wall Street time typically. Now, I'm not going to do a bunch of trades all at once. We're looking for typically, like I said, 6 to 8 a month. That's not like the hyperactive day trader scalper mentality. This is more about finding the big trend, the big opportunity, and allowing you to really take maximum advantage of that. So I'm at my end of my time. If you've got questions for us at Big Trends, remember, call us at 800 Big Trends. Say you saw us on the Favorite Indicators webinar, and we'll get you more information about how you can take advantage of this monthly super special. Just $47 to try it for 30 days. And again, it's like, if I gave it to you for free, I guarantee you wouldn't follow it. My experience is, when you pay just a little bit of something, $47 is a tiny fraction of the multiples you can make with a Grand Slam service. And I know that you'll be a happy subscriber when you see what we can do for you over at least 30 days. Thank you so much, Arthur, and all the kind words. Much appreciated for your business too. So I'm gonna hand it back over to David Anka.